Hello there, I'm Gemini.
For a lot of us Canadians, let's be honest, owning property down in the US is a big part of the dream. You know, a sunny winter escape, a solid investment, or maybe a bit of both. But here's the thing. Behind that sunny dream, there's this surprisingly complex web of cross-border tax law that can turn a fantastic investment into a real financial headache. So, in this explainer, we're going to untangle that web for you.
And this quote right here, this really gets to the absolute heart of the problem. You can get what sounds like brilliant advice from a US lawyer or an accountant, but if they don't get the Canadian side of the picture, you could be heading straight for disaster. And that is exactly why we're doing this. It's all about learning to think on both sides of the border at the same time.
To get through all this, we've got a really clear roadmap. We're going to start by really defining what this cross-border tax trap is. Then we'll build ourselves a toolkit with 5 key factors you absolutely have to consider. After that, we'll apply that toolkit to the most common ownership structures, see a head-to-head comparison of how they actually perform, and then finally, we'll cover 2 major hurdles you need to know about, withholding taxes and the big one, U.S. estate tax.
So, let's just dive right into the core problem. The dream itself is simple, right? Buy a place in the States. But the reality, well, the reality can turn into a bit of a nightmare if you're not ready for how 2 completely different tax systems can clash. You know, this isn't just about paying tax in one country or the other. It's about how those 2 systems talk to each other, or in a lot of cases, how they don't talk to each other. A structure that makes perfect sense in the US can create some really painful and expensive problems back here in Canada. The right plan from day one is everything.
So, to build that right plan, you need a framework. This next part is all about giving you the 5 essential questions you need to ask about any ownership structure you're even thinking about. Think of this as your personal evaluation toolkit for everything that follows. Okay, let's break this down really quickly. First up, the U.S. long-term capital gains rate. This is a big deal. It's a much lower tax rate, around 20%, but you can only get it if you're an individual or use specific flow-through structures. Second, tax deferral. Can the structure let you keep profits in a company at a lower corporate tax rate? Third, and this is a monster, the risk of double tax. Are you going to end up paying tax to both countries on the exact same dollar because the rules don't line up? Fourth, U.S. estate tax. What happens if you pass away while owning the asset? And finally, the filing requirements. Who exactly has to file a U.S. tax return every year?
Now, this slide here is a perfect way to make that double tax risk feel real. So imagine this. You sell your property and the buyer agrees to pay you over 10 years. In the US, the rule is you report that income over those 10 years as you get the cash. Simple enough. But in Canada, the rule says you have to report the entire capital gain within a maximum of 5 years. You see the problem? For the first 5 years, you're paying Canadian tax on money you haven't even received yet. And you haven't paid US tax on it either, so you have no foreign tax credit to claim. It's a classic timing mismatch, and it's a perfect recipe for getting taxed twice. All right, so now that we've got our 5-factor toolkit, let's put it to work. We're going to walk through the 5 most common ways that Canadians own U.S. real estate, and we're going to see exactly how they stack up against our checklist.
Okay, first up, the most straightforward path, just buying the property in your own name. The pros are pretty obvious, right? It's simple, and boom, you get access to that amazing U.S. long-term capital gains rate. But the cons, they are significant. You have unlimited liability. That means if someone sues you over something that happened at the property, your personal assets back home in Canada are on the line. And you are 100% exposed to U.S. estate tax.
So, what about using a Canadian corporation? This is a great example of the trade-offs involved. You solve the liability problem instantly, and you completely sidestep the U.S. estate tax issue. That's a huge win. But you lose access to that preferential capital gains rate. And even worse, you introduce a whole new layer of complexity with Canada's foreign accrual property income rules, we call them FAPI rules, which can create a whole new set of double tax headaches.
Now for a much more sophisticated option, a Canadian Limited Partnership, or an LP. This structure can be the best of both worlds. The income flows through to the partners, so you get to keep that amazing long-term capital gains rate. You get limited liability, and it's super flexible for estate tax thanks to a cool trick called a check-the-box election. So what's the downside? Well, it's more complicated and more expensive to set up and run, and every single partner has to file their own U.S. tax return.
Okay. I need everyone to pay very, very close attention to this next slide. Seriously. If you take only one single thing away from this entire explainer, please let it be this. This is, without a doubt, the single biggest trap for Canadian investors. The U.S. LLC. It gets recommended all the time by U.S. advisors because for an American, it's fantastic, it's simple and effective. For a Canadian, it is a tax disaster. And here's why. The U.S. looks at an LLC and sees a flow-through entity. It's invisible for tax, and they tax the owner directly. But Canada looks at that same LLC and sees a corporation. This complete mismatch is catastrophic. You end up paying personal tax in the U.S. immediately, but you can't claim a foreign tax credit in Canada until years down the road when the corporation finally pays you a dividend. The result is just crippling double taxation. Avoid it at all costs.
So our final option here is the U.S. C Corporation. Just like a Canadian corp, it gives you that crucial limited liability. And it has a really unique benefit. It can help you avoid a nasty withholding tax on the sale that we'll talk about in a minute. But the cons here are pretty steep. When you finally want to pull your profits out and bring them back to Canada as dividends, the combined overall tax rate can be incredibly high. Plus, the shares of the U.S. corporation themselves are considered a U.S. asset, which puts you right back in the path of the U.S. estate tax.
So, we've gone through the theory, we've weighed the pros and cons. Now for the moment of truth. Let's see what all this actually means for your bank account. We're going to take a hypothetical $100 capital gain and see how much cash you actually get to keep in your pocket under the best and worst structures.
And wow, this chart just says it all, doesn't it? Look at that staggering difference. If you own the property in your own name or through a limited partnership, you walk away with $73 in your pocket after all the taxes are paid. Not bad. But if you use a U.S. C Corp, that number plummets to just $37. And if you fall into that dreaded LLC trap, you are left with a measly $27. The structure you choose directly decides how much of your hard-earned profit you actually get to keep. Just let that number sink in for a second. $46. That's the difference between the best case and worst case scenario on that chart. You could lose nearly half of your profit, not because you made a bad investment, but simply because you picked the wrong legal entity at the very beginning. This is why we say structure matters. It matters a lot.
Now, even if you nail the ownership structure and pick the perfect one, there's another hurdle you need to be ready for the second you decide to sell. It's a U.S. rule called FIRPTA. And if you're not prepared for it, it can be a major, major cash flow surprise.
So here are the key facts you just have to know. FIRPTA is a withholding tax. The person buying your property is legally required to hold back a chunk of the sale price and send it straight to the IRS. And here's the kicker. The standard rate is 15% of the gross sale price, not your profit. So on $1 million sale, that's $150,000 withheld right off the top, even if your actual gain was tiny. Now, this is just a prepayment on your final tax bill, and you can file paperwork to get it reduced, but it's a critical step you absolutely cannot afford to ignore.
Finally, we have to talk about the elephant in the room for any serious long-term investors south of the border, the U.S. estate tax. This is a tax on the value of your U.S. assets when you die, and believe me, the rates are steep.
So this tax applies to what they call U.S. situs assets, basically U.S.-located stuff, like your property. For a non-resident, the basic exemption is a tiny $60,000. Now, thankfully, the Canada-U.S. tax treaty gives us a huge break, allowing Canadians to use a much larger exemption, which is currently up around $12 million. However, and this is a really critical heads up, that huge exemption amount is scheduled to be cut in half in 2026. For any value above the exemption, the tax rate can be as high as 40%. This is a massive potential bill that your ownership structure absolutely needs to plan for.
So after all of that, if there's one thing you walk away remembering, what is it? It's this. Choosing your ownership structure is not some minor detail you figure out later on. It is the absolute foundation of your investment. And as we saw so clearly with the LLC, sometimes the simplest sounding advice from a purely U.S. point of view can be the most financially damaging choice a Canadian can possibly make.
And that really brings us right back to the beginning. That dream of owning U.S. property, it is absolutely achievable. But a dream without a solid plan is really just a wish. So the real question you need to ask yourself is this. Are you building a financial structure that's actually strong enough to protect that dream from all the complexities of cross-border tax?